Hi, welcome. In today's episode, I will be looking at Inpost. We'll be doing fundamental value investing based analysis of the Inpost company, and we'll be also focusing on the Warren Buffett's way of investment and thinking to determine if this company has good competitive advantages, good moats that will protect its business from competitors. Firstly, this company is after a significant price drop, going down from around 19 to the current price of around 10, which is nearly a 50% drop from its local high. Although if we go back 3 years, we can see that at the beginning of 2022, the price crashed as low as 4. So it was lower in the past, although the current price is also moderately low, especially compared to the high of 19 euro per share. And this company is noted on many different stock exchanges, so you can buy it on Euronext, in London, in Germany, in the USA, in many different countries and many different stock exchanges, which also lets you pick the best currency to buy it in. Me personally, I'm buying this company in dollars, in United States dollars, because in my opinion the current price of dollar compared to euro or to Polish zloty is low, so I prefer to buy with the low cheap dollar, US dollar. Right, and let's look at the financials first. The revenues, as you can see, they are stably growing, and each year the growth is more than 20%. In 2022 it was nearly 60%, then 2023 it's 25%, 2024 also around 23-25%, and in 2025 the growth is a little bit higher than 30%. So the revenues are growing very fast. It is even growing faster than companies like Google, for instance, but of course Google is much bigger than Inpost, and also in a different type of industry. So what we want to see also is the follow-up in net earnings and of course the margins, because big increases in revenues, okay, that might be great, but it would be super great if we also see increase in net earnings, not only in the market share. All right, and if we look at the earnings from the sales, we can see that they are also growing. They are over the last 4 years. We can see that only in 2025 the earnings were growing still, but only a couple percent. But before that, in 2022 it was around 15%, 2023 around 60%, 2024 30% growth. So it isn't super stable, but we can see that it is there. And if we look at the net earnings, we can see that the growth is, the blue line here is the overall sector, so also the competition. And we can see that this company tends to behave similarly to the sector overall. So we can see that the growth of this company in 2023 and 2024, it was much higher than the average, but in 2025 there was a decrease of the net earnings. But it is important to understand that the net earnings can look bad because of high investments. So if the company invests a lot, they are not showing a lot of profit, therefore they are not paying a lot of taxes, and they are growing rapidly. So it is very important to see if this company is having financial difficulties, or maybe this company is just investing a lot. In here, we have similar data, just presented in a different format. We have the total revenues with the exact numbers. And the most important thing that also Warren Buffett looks like is the gross profit margin. I'll grab my pen. This position right here, the gross margin of around 80-70%. This is huge. This is completely huge. Google has gross margins of around 50%, something like that. So those margins are just, wow, amazing margins. And the net income margins are also good. But look at the difference between this margin and this margin. As I told you already, it is very important to look at the investments. Maybe I will give you a little spoiler. There are a lot of investments. That's why this company is growing also so rapidly, right? And the price to earnings ratio looks high, especially for the Polish company, when the overall stock market tends to have much lower readings, and it is possible to find companies, good companies, trading at a PE ratio of 10, maybe even a little bit lower. Although in here we have this massive growth and this huge gross margins, and also a lot of investments. So the investments are decreasing the net earnings, but in reality, this PE ratio should look much better. Let's look at the balance sheet right now. We have a lot of assets, and a lot of those assets are in things like real estate, some land, etc. So the goodwill is around 20%. Well, it's not goodwill, but it's all of the intangible assets. So majority of the assets of Inpost are intangible assets, which is good to see. And also short-term assets are 4 out of the 12 overall assets. Those are in millions probably. So the company looks healthy. There is some short-term investments, etc. There is some money in the bank, but not a lot, although it grew in the last year. Right, and if we look at the debt of the company, you can see that this company has quite a lot of money in debt. This is around 8 here. This is the long-term debt. And the structure of that is financial lease is around 2.5 and debt is 5.5. And there's also some short-term liabilities. They need to pay around 2.1 for services and other goods that they're buying from different businesses, and also they have less than 1 in short-term debt. And here this is the financial lease, another one. So it looks good, especially what is good about the balance sheet of Inpost is that they don't have a lot of intangibles, because sometimes the value of the intangibles of how they put it into the books, it can be manipulated. So in here it's not so high. There is a lot of real value behind the balance sheet, although the price to book ratio, as we will see soon, is quite high. It's because the company has great way of generating profit, but that also means that with small amount of investment they can have great returns. The return on investment capital is around 12%, so it's really great. Then in here we have cash flow from operating activity 2.5, but sadly amortization depreciation is 2 out of that, so this is a huge level, and sadly this cost can add up in the future. So for this company, markers like EBITDA, for instance, they will look super great, while in reality, well, of course, amortization, depreciation, those are real costs, right? If we use some machines and they create amortization, then, well, we need to buy a new machine after some point. It's a real cost, so don't look at EBITDA, especially for this company, because it will mislead you a lot. And in here, minus 2.3, rounding up, this is an investment. So we can see every year this company has a lot of investments, which is driving the profits higher and higher. Right, and let's look at the valuation ratios. The current price to book ratio is around 7. The price of the stock compared to the revenues is around 1.5, really good. Price to earnings, net earnings is 25, but this is because the company has a lot of investments that are decreasing the net income. So in reality, it looks better. And if you look at this position here, this is the price compared to operational activity, the earnings coming from operational activity. You can see that this number is much lower at 12. So yeah, this company isn't currently very expensive, especially if you look at the gross margin and the growth. And here we'll look at the percentile rank. So a percentile rank, and here we have a little example. If we have the price to earnings ratio in the 7th percentile versus the 10-year history, only 7% of Inpost historical price to earnings readings were lower than the current one. So in here, 7%. Currently, this price to earnings ratio is very low. Very low. It is also the same for price to sales. It has never been lower. But of course, if we look here, we can see that the company started being noted on the stock exchange only 4 years back. But in this time, in those years, this company never saw this marker, this indicator price to sales lower than it is currently. For the price and book value, it is at 8%. So it is also very, very low, which is good. And here we have more percentile rankings. All of them are at 1 percentile, meaning that this company, at least for those markers never have been at a better price compared to them. And the valuation yields. From here, I only want to look at the buyback yield. There is a little bit of buyback, around 1% each year, but this is good. That shows that the company thinks that currently the stock is undervalued, which is good, Right, and here we have margins. There might be a little bit bad to see, so I will go to the next slide. And here, return on assets, as you can see, it's around 10, 9, 8%, but the return on equity goes up dramatically. So it's 66%, 55, 40, 30, 30. So that means this company is losing quite a lot of debt in order to grow. If we see such a huge disproportion between return on assets and return on equity, which is good because we have those huge gross margins. So it's good for them to take on a lot of debt. And I am actually happy that I see that they are using this debt. But of course, are there liquid? Are there going to be any problems in the future? This is also very important. We'll look at it soon. And yeah, margins and profitability. The numbers here, wait, what were they called? Oh, percentiles. They are in the middle, so meaning that the margins are average compared to the history. They tend to be at these levels. Right, and here we have the return on investment capital. Currently it's around 11, but in previous years it was also 16, 13%. So this is a good return on investment capital. And here we have some debt ratios. The overall debt ratio is at 0.8%, which was stable for all of the previous years. So yeah, there is nothing super crazy. Maybe the long-term debt at 2.8. This is much higher than the industry average, which is 1. But remember, if this company can generate those great returns, it's good for them to go into debt. But it is important to look also at liquidity. We'll do that soon. All right, so Leverage at those levels. Net debt to EBITDA, yeah, sadly in here we have EBITDA. So all of those markers aren't great because this company has a lot of amortization, depreciation, etc. Right, so the debt, if you look here, this is the net debt. It is growing a little bit in the past years, but nothing crazy. I want to see the liquidity here. Right, so this is the cash ratio 0.3, so 30% of all of their debt they have in cash, so this is great. This is the fast liquidity, 0.84. Well, usually this number being close to 1 signifies that this company has enough funds to pay back all of its debt. But remember that this company also generates a lot of money, so and it generates a lot of money stably every year. This company has not been losing money, so it's a really great investment. At least it hasn't been losing money for the last few years, right? When so here we have the data from 2021, right? Before that it wasn't on any big stock exchanges, so that's also important to note. But those markers close to 1 and the great ability to generate profits seems like it's a quite safe investment. Right, and here those are the goods cycle. So if they produce something, how many days does it take for them to sell it, etc. What we want to see there is it being stable. So if those the amount of days they need to get the money, or maybe they have a lot of product laying around, nobody's buying them, then this will go up, but it isn't. So this also looks very good. Dividend yield, this is very great because it is 0%. As we know, the dividend can be double taxed, so it's actually beneficial not to pay out dividend if the company can invest it, right? Because if they make $100, they pay, let's say, $20 in taxes. So after taxes, they have 80, then they pay you the money and you pay taxes on it again. And maybe you are left with, I don't know, $64 out of the 100. So if you can see, you lost nearly 50%. So that's why dividend isn't that great, because it's double taxed, while investments are like completely opposite. So when you invest $100, you pay $20 less in taxes, right? Because investments are expenses. So in here you lose $36, in here you gain $20. So it's a massive difference. So it's good that it's 0%. In here there's some analyst data. A lot of them are saying that the price of the stock should be higher. A lot of them are recommending buy, and of course we don't know who those analysts are, but it's probably some banks, investment banks, etc., brokerage houses. So it's good to at least see that they think that the price should be actually higher than it is currently. And of course they are using a lot of like economic finance theory. So if you like those type of formula, they're probably the result of those formulas are in here. All right, so that's everything for today. I think Inpost is a great company. The price to earnings ratio might look high, but this is because the company has a lot of investment, which is great, a lot of growth. This is also super good, and great gross margins. This is amazing. They of course have some problems. For instance, in the UK, people tend not to like this patchcomat so much, but maybe the price needs to change, or they need to adopt. And yeah, different markets operate differently. For instance, in Poland, it's very great to have our packages delivered to the patchcomat, because in England they can just leave it in front of your door, but in Poland it might be stolen. So, you know, depending on the region, it has different probabilities of making a lot of money. But as we can see from the rapid growth of revenues, everything is going fine with this company, and for sure there isn't a reason for the price to drop 50%.